let's hop into this Mortgage Bankers Association piece. Quarterly survey of commercial multifamily happenings. Quarterly survey of commercial multifamily bankers originations Q3.
Yeah.
It's not up. It's probably down. What's the
It's not a full report as much as just like a data release, but this data on CRE.
Here. That's why folks are here.
That's right. We can break it down for you. But to be honest, this data really just confirms what we've already been going through. The numbers give you an idea of the scope of the issue, and it's good numeric proof of this clear change that we really have lived through. We've noted and discussed and really cogitated upon, and to see
what are we on?
Cogitated. And really just to see it laid out here is really effective, and it puts things to the test in a way that you really don't see. And that graph is specifically is what I was thinking about is you can see how much the originations have changed from 2020 2021 where they Q4 where they really peaked to 2023, and really we're not at the 2019 rates at the moment. We are currently hovering around the 2015 rates of originations. 2023 is equivalent to, and that's not even accounting for like interest or for inflation or anything. Naturally you would see this increase, but we've really kind of backslid, and specifically it's multifamily originations are down 50% from last year. And if you do the math, they're actually down like 41% from the pre-pandemic 2019 numbers. So that kind of gives you this idea that like, oh, even in a normal pre-pandemic era, we're only like 59% of where we should be. Yeah. And I would argue that the increased competition from investors should mean that we should have more. We should have a bigger number there, but we're just not there. And I also think even more broadly, it's interesting to see how other CRE sectors have gone through a similar process in the past 3 years. There's a few instructive base effect examples that you can see too that show how a large decrease one year can make an increase the following year seem so much larger. If you scroll down to this table that they have, where they have this information, and I'm looking specifically at hotel. So in 2020, hotels, there was a 94% decrease from the year before. And then the following year, 2021, there was an 866% increase in loan originations. So, but really, if you're going with that 2020 number, so you're going from like 6% of the 2019 number, and then after that 866% increase, you're really at like 58% of the 2019 numbers.
Yeah, exactly. Yeah, exactly.
So, the big numbers following the big decreases, and it's just really interesting.
A little bit of a swing right there.
Yeah, it is a huge swing, and it does seem like, you can...
And now they're down 52%.
Yeah, well, and the other interesting thing here is for all these sectors, you see the big swing up in investment in 2021, and then it dips down in 2022 and down even further in 2023. Except for healthcare is this weird exception.
Yeah, healthcare's...
Where it it actually, while everyone else sank, where everyone else dipped down in 2022, that was where it peaked for the past 4 years. So it was, it didn't have as big of an upswing in 2021, but it had a big upswing in 2022, and now
it's having a big fall off.
Yeah, it has now healthcare has the biggest fall off in investment of all the sectors. So just strangely different timing, because you would think that 2022 would be more subdued due to interest rates, but there must have been some other pushes there. I wonder if there was some more increased investment projects that got started in 2020.
Yeah, I was going to say it could have slightly different, drivers.
Yeah,
and not, the pandemic.
Exactly.
Effect, and
like let's get more built and that kind of thing. But
we have to build. We test COVID testing centers everywhere.
But ultimately, the picture of this is one of reduced transactions. No matter how you slice it, we are, we're seeing lower transactions, and it's it's hard not to think that it's from the higher interest rates. And I also think, and we'll see this here in other in other articles, that these higher interest rates also accompany like a more stricter position from the banks, and a greater. You kind of alluded to this, but a greater awareness of the of like the riskiness of certain assets. Now, if we can skip ahead to the Reuters article, I think that hits on the nail on the head, really, of this idea of risk and where the banks are when it comes to risk, and where, even more importantly, I guess, where U.S. regulators are. The headline here is U.S. regulators agree to ramp up oversight of systemically risky non-banks, which I think that's some pretty powerful implications behind this vague non-bank descriptor. So it seems a little harmless, but they're basically taking aim at a large group of people and institutions that provide money to others, but aren't technically classified as a bank. And this is one of those things, and I was talking to you before recording here about, I'm kind of confusing myself if I think about it too much, because there's so many things that a bank lender does that are pretty similar to an investor. I know that there's a different position in the capital stack, different risk rates, guarantees, but like a bank is kind of doing, they're giving money today in exchange for money later.
Well, the one's got a charter from the Federal Reserve.
Yeah, and I think, that's what I was kind of anticipating. It's like the key difference there is it has the kind of imprimatur of the government and has that officialness, and which also comes with regulations. And I think that the
Federal Reserve is the government.
Well, the government. I'm joking.
Sort of, not really.
I would put it in the same box, but it's
gotten the license from the cartel. They've gotten the thumbs up.
But like it just does, like, it gets me thinking about this fuzzy line between private investment and a more strictly regulated bank, and what rules the banks are required to follow, and the capacity of these banks to follow the rules. Yep. And I may be speaking out of turn here, but I think the open implication, and I've got a couple more paragraphs in my notes here about it, the open implication is this going to be a case where the big non-banks are going to help the regulators set the rules, and then the smaller non-bank lenders are going to be kind of cut out of it, are not going to be able to operate like they wanted to, which seems counterintuitive. If you're trying to reduce systemic risk, wouldn't you want that spread around more smaller banks that have?
How is Jamie Dimon going to,
Yeah, that's true. He's got
grow JP Morgan, Chase, another, $1 trillion in assets or whatever.
Yeah,
that's not going to help. That's not going to help him.
Yeah,
so if you, that's as simple as that.
Yeah.